Up next, we have Peter Schultz. Peter Schultz is the editor of The Winning Secret, a weekly credit spread trading service and the president of Cash Flow Heaven Publishing. Peter has been showing self-directed investors how to trade successfully since 1996 and is nationally known as a speaker on options trading. He's the author of Passage to Freedom, the Options Success Trading Package, the Winning Secret Trading Package, the Explosive Profits Package, and the Greatest Options Strategies on Earth. He's also written several important short reports on innovative option techniques and is a popular guest on radio and television talk shows pertaining to trading and the financial markets. Peter founded Cash Flow Heaven Publishing in 1999 to help individuals obtain a better lifestyle through trading strategies proven to produce exceptional monthly returns. And just before I let Peter come on, I just want to remind you guys the room is filling up. So just remember, if you leave, you will not be able to get back in if we hit capacity. Other than that, Peter, it's all yours.
Thank you so much, Kevin. I really appreciate the introduction, and it's just wonderful to be here. We've got a lot of information to cover. This is a picture of me. Kevin did a great job of introducing, so I don't have to hopefully talk too much about myself other than to say I've been trading options a long time. I know how much money you can make, how much money you can lose, and how much more fun it gets when you start putting the probabilities in your favor, and that's exactly what we're going to talk about. You're going to probably want to take notes. We've got a ton of really, really good information to cover here, and I think you're going to be pretty inspired by the end of it. And I'm going to try and get to some questions too at the very end. So I'm going to just get started. If you can hold your questions to the end, that would be wonderful. So the title of this presentation is How to Retire in 5 Years or Less on $13,000 per month tax-free. Now, I don't know if that seems like a lot of money to you per month or a small amount of money, but I want you to know that that amount of money is variable, and you can certainly make more, and you can certainly get along with less. And if you are satisfied with less, this will be easier. But as you can see with this method, anything is possible, and I'm going to show you a very, very realistic way to get there. So if we're going to do this, if we're going to retire safely and securely through a trading plan, we need a really good plan. It needs to be safe and it needs to work. So $13,000 per month is a pretty tall order, especially if you don't have a lot of money already set aside. So how are we going to do that? How are we going to go about that? So first of all, what do the professional financial advisors say we need? So if you've done a little bit of this, if you've been in and talked to a financial advisor or two and you're trying to plan for your retirement, it can be a pretty sobering experience. So $13,000 a month times 12 equals $156,000 a year. And so if we're getting, say, 2.7%, which where that number comes from is that's about what the 10-year bond is paying right now. A lot of people for their retirement accounts have money in bonds. They like the safety of that. But to get $156,000 a year, you're going to need $5,777,777. If you happen to have that tied up in bonds right now, my hat's off to you. You've done well financially. That's great. If you haven't done that, maybe we need a little different plan. Even if you're getting 5% a year with some good dividend stocks, you're still going to need over $3 million. Now, I know I'm a little bit preaching to the choir here because we're pretty much all traders. So I know you're not satisfied with those kind of returns. The problem with trading is you can make money and you can lose money. So pretty much our whole point here, our big overall scheme here, is to get the probabilities so far in your favor that you feel really, really comfortable about what you're doing with your actual retirement money. So I'm not talking about your gambling money. I'm talking about money that you really need to be there 2 years from now, 5 years from now, and 10 years from now. So once again, we need a plan and we need a good one. We need to get substantially better than conventional returns. So I'm just saying that we can do better. So we need to do it safely. And in the world of investments, there is always uncertainty. So our plan has to have a high mathematical probability of success. And as you're thinking about this, how does 85% to 90% sound? Now, what's interesting is if you go into your financial advisor or your broker or any place where you've got perhaps mutual funds or some other money set aside, and you ask them, what is my probability of success at that? They will just give you a big blank look. They'll say, well, the market doesn't offer any guarantees, that the S&P 500 goes up and it goes down, bond rates go up and they go down, you're just taking a little bit of a risk here. Well, what's kind of nice is if you kind of like to know what's going to happen with your money, it's really nice to know some probabilities. So in thinking about all the investing you've ever done, would 85% to 90% be at the high end of your probability? Or the truth is do you even know what the probability of your investments are? Very few investments come with any kind of a label. Well, the really cool thing about options trading and options, and one of the things I really, really like about it, is you can calculate the mathematical probabilities, and it actually, over the long run, works out very, very accurately. And so we're basing our expectation on the Black-Scholes options pricing model, which won the Nobel Prize for Economics in 1997. Now, I know if you're some dyed-in-the-wool options trader that's been around forever, you know that they've modified that pricing model over the years. There's other ways to improve on it, and that's great. I just want to give you an overall concept here. What we're trying to do is stack the odds so far in our favor that we're not so worried about our investments. We have a high degree of confidence that over the long run we're going to actually end up in really good shape. So we're using a strategy that takes advantage of the Black-Scholes pricing model, and this strategy is based on selling options instead of buying them. So once again, it's really important to kind of get your mindset right. Now, when you buy options, generally speaking, you are in speculative mode. And you know what? I still like to buy options. I'm not all one way or all the other, but when I buy options, I'm sort of using my speculative money, my gambling money, and I'm planning on hitting it out of the park. This is the kind of trading I want to make 100% on or 150% on. And I just shorted the IWM with some puts this last week, did really well on it. But that's not what we're talking about here. What we're talking about is the kind of money that you're sitting there going, you know what? When I'm ready to retire, I want to be on a beach in Hawaii, or I want to be over in Europe, or I want to be hanging out, and I don't want to have to worry so much about how my investments are doing. So the way that you can do that with options, one of the reasons options is so fantastic if you haven't traded options before, is you get this whole great big wide continuum of risk. You can be all the way over on the risky end of the spectrum, and that's kind of where options have gotten a bad name, is where people threw the dice and they lost all their money and they go, gosh, options don't work, and if they didn't work for me, therefore they can't work for anybody, and they'll try and talk you out of it at the next, barbecue you're at with this person or whatever. But the neat thing about options is you can be all the way over on the other end of the spectrum, the very, very safe end of the spectrum, and that's what we're talking about here. And I would make an argument with just about anybody that being at the safe end of the options spectrum is actually substantially safer and more conservative than the buying and holding stocks that financial advisors have been recommending for their most conservative clients forever. So if you're not into this, if you don't know a lot about selling options, this is going to be a little bit of a revelation for you. And I think it's going to be kind of fun. It's just a really cool thing to just win the vast majority of the time. So the reason it's important to sell options instead of buying them is you have a much, much better chance of winning. If you've ever bought an option that expired worthless, have you ever wondered where that money goes? So this is really interesting. At the very beginning of my options trading career, and if you're an options trader and you can relate to this, my hat's off to you. If I was sitting next to you, I'd put my arm around you right now. I mean, this is just kind of where you start out. I saw these options, and an option would be going for cheap, 50 cents, $1, $1.50 or whatever, and you could buy a whole bunch of them, and then you'd see them, maybe you didn't buy them, maybe you're just observing, and you'd see the stock, blast off one way after an earnings announcement, or plunge or whatever. You go, holy mackerel, those $1 options turned into $10 like in overnight. I mean, I could have made $1 zillion, and you get so darn excited and you start making some of these trades, and some of them work and a lot of them don't. And unfortunately, after working with hundreds and hundreds of options traders and talking to them over the years, what happens with folks is usually sooner or later they end up blowing up their account, and they don't have any money left in their account. They feel terrible. They punch themselves in the face. They have a hard time explaining it to their wife or their husband, and it's pretty dang frustrating. And so I used to sit around and I go, God dang it, this is back in the learning phase of my options career, and I'd go, God darn it, I just lost, $10,000 or $8,000 or $15,000 or whatever. Where the hell did all that money go? Where did my money go? And, does the broker get it? And I go, well, no, just, the broker just gets a little commission for the transaction. I go, oh, did that God darn market maker down on the floor get it? Well, no, the market maker just gets the difference between the bid-ask spread. So, where did all my money go in, and where did all the money go of all the people that all ever lost options? And I just pictured this just gigantic mountain of money sitting somewhere of all the money that was lost from all the speculative options traders. So where the heck does all that money go? Well, it's estimated that just this year alone, $1.116 billion worth of options will be traded. It's also estimated that over, get this, 85% of those options will expire worthless. Now, if you go to the CBOE website or the options board, they're going to say, oh, not all those options expire worthless. People got out of them at the last minute before they expired worthless. It's kind of splitting hairs. If you sort of add up what goes on there, a lot of options expire worthless. Either that or they're worth a heck of a lot less at expiration because all that time value goes away. So that comes to approximately $949 billion worth of expiring premiums. So ask yourself, that is quite a mountain, $949 billion. That's just this year. And by the way, options have become so popular that the options volume just increases every year. I mean, every single year they break records. So, next year it's going to be more than $949 billion. That amount of money increases every year. So how much of that $949 billion of expired options premium do you need to retire? I mean, as a percentage, it is a very, very thin slice. So for the purpose of this webinar, we're targeting $13,000 per month. But as you'll see, that amount can be just the beginning. The strategy we'll use is called selling credit spreads. So what is a credit spread? A credit spread is simply selling an option and then buying another option to hedge. So there's a lot of ways to sell options. Some people are into covered calls where you buy the stock and then you sell a call against it. My problem with that is stocks are expensive and you tie up too much of your money buying that stock, and so that reduces your return on investment. Other people sell options by just selling them naked. I don't like that because there's something about that infinite risk that kind of bothers me a little bit, or the risk from the stock price all the way down to zero in the case of puts. And it actually kind of bothers your broker a little bit too. So if they do allow you to do that, they are going to tie up a huge amount of your account in margin. So the solution is to sell an option and then buy another option to hedge to limit your risk. So where the credit comes from is the option we are selling is more valuable than the one we are buying, so it creates a credit in our account. So credit is money you can use to buy stuff, you can take it out and spend it, you can reinvest it, you can do whatever you want. So what's really, really cool about this style of investing is that you get your money first. So almost every kind of investing I know out there, you invest your money and you hope and pray and you cross yourself and you burn the goat entrails on the TV set and you do all the little things to try and help that investment go up in value so that you can sell it and make your money when you sell it. What's interesting about this is you sell first. You get the money, and then the duration of that trade just tells you how much you're going to end up with at the end of the trade. So this is a different way of doing things, but I like that, getting paid first, and I think you'll like it too. So let's just give you an example here, and I'm going to get down here and I'm going to get my little red pen, and I'm going to just show you a trade. So this is Chipotle Mexican Grill, big high flying momentum stock. And so what happened is it kind of for you technical traders out here, it broke support, the floor here, went down, and was sort of languishing here in the basement, and then earnings came out. Holy mackerel. So this thing just gapped through the ceiling, ended way up here. From a technical standpoint, as you know, gaps are very positive. It retraced a little bit, did this little V thing, and then starts going back up again. So this is really, really bullish. This is bullish price action. So what we're going to do is we want to sell an option that we think is going to expire worthless. So the cool thing about these trades is we always know our finish line. We're not just going to, get into the trade and hope something nice happens. We know, come heck or high water, when this thing is going to get over with. And this line that you see right here is expiration. So this is just an example of one that was done in February. And so we sold the 515 put because we think the stock is going to go up, and we think in the next couple of weeks or so that this put is going to expire worthless. So we got $1.55 for this put. Well, the thing is, if you just sell a put, what you're doing is you're selling somebody the right to put the stock to you at $515, and they have that right until expiration. So the problem with that is you've got this risk all the way down to zero. I mean, if the stock went down to $10 a share, they can still put it to you for $515. So what we're going to do is we're going to turn around and we're going to buy, in the same transaction, the 510 put. So we only have $5 of risk here. That's our only risk. That's the most that we could possibly lose. And we are going to get the difference between these two. So we bought a put for 105, we sold a put for 155, and the difference is 50 cents. So go over here to figure out what our rate of return is. So our 50-cent credit divided by 450. So you can see that the max we can lose here between these two strikes is $5. Well, we already got 50 cents. So now the maximum that we can lose is $4.50. So we take our 50-cent credit, what we immediately took in, and you know what, 50 cents doesn't excite you. The cool thing about options is you multiply everything by 100 per contract. So, you know, one contract is 50 bucks, 10 contracts is 500 bucks. If 500 bucks doesn't excite you, do 100 contracts, and now you got $5,000 hitting your account. So you can scale this up pretty much to any level you want. So a 50-cent credit divided by a $4.50 possible risk is an 11% return for just, gosh, what is this? About 2 weeks of time, this distance right here. Now, I just have to tell you, maybe you're a big-time trader and you like to do, you know, Forex, and you like to do all this leverage and options and crazy stuff. You go, well, Peter, you know, I like the idea of doubling my money overnight. Well, you know, to tell you the truth, I like that idea too. But what we're talking about here is probabilities. So with this, your probability of winning is through the roof. And I have to tell you, if you want to do some inspiring math, it's going to get you kind of excited. Take a look at making 11% every 2 weeks. And even with a modest, say, a $10,000 account or even a $5,000 account, you make 11% every 2 weeks, and you are going to be a zillionaire. So I mean, if you want to get excited about making money, start compounding this. So it gets really exciting really quick. So this is the concept. Okay. All right. So what's really cool about this is called a put spread, or a bull put spread. Bull because we think the stock is going to go up, and a put because we're selling puts. But if you think that this is going to languish, you go, okay, it's already made its pop. We think it's going to stay in a little bit of a range here for the next couple of weeks. We can also turn around. You know, this is all predicated or based on what you think the stock is going to do, of course. It's just the cool thing about it is that you don't have to be so accurate. So we can go up here, and we can do, because we don't think the stock's going to go up quite so much, and call because we're selling calls. So in this case, we're going to sell the 570 call for 95 cents. We're going to sell the 575 call for of 55 cents. Now here is the really, really cool thing. So the way brokers are now, they've gotten a little bit more sophisticated than when I used to trade options. When I started trading options back in the 90s, they'd make you hold margin for both of these spreads. Well, even the brokers, as risk adverse as they are, have figured out that a stock cannot close both above and below your two wings. These are called wings at the same time. So, you know, when we did this put spread down here, they made us set aside $4.50 per share. So that's $450 per contract for each contract that we did, and they kind of lock that up in your account just to make sure that you've got the money to cover a loss if things really go wrong. Well, here's what's really, really cool is they figured out that since the stock can't close above your call spread and below your put spread at the same time, they're only going to make you hold one set of margin. So you can do this trade up here. Once your put trade is in place, you can do your call trade without holding or setting aside any more margin. So this is a way to just really increase your rate of return without tying up any more money. So we're going to add this 55 cents to the 50 cents, and let's see what we get. Wait a second. Should have a little bit of math here. So we add 50 to 55, and we get a 105 credit. And because you subtract the $1.05 from your maximum loss, which is $5, now our maximum loss is $3.95. So you see where your credit goes up, your risk actually goes down, or the amount that you could lose actually goes down because it's subtracted from this maximum $5. So a $1.05 credit subtracted from a $3.95 margin hold equals a 26.5% return for just 8 trading days of time. When I say trading days, you realize that you don't have any risk on the weekends. I mean, the stock market can't go against you, it can't go for you, it's just inert. So we've just got 8 days to the finish line, and we're making 26.5%. This is getting to be kind of a typical trade for us now. So I've done just a whole bunch of experimentation to get on just that right point of the time decay curve to sell just enough time to get the credit that we need and end up getting some pretty generous credit. So I don't know if you used to trade credit spreads back in the day or if you're familiar with this strategy, but until the weeklies came along, you couldn't do this. And I'll get into more details on that, but all I'll say about this is there has never, ever in history been a better time to be an options trader, and particularly to be a credit spread seller. The bid-ask spreads have narrowed, the premiums are better, they've got weekly options on a whole bunch of things now so that you can pick the Friday that you want these to expire and get right on the perfect part of the time decay curve. It's just, there's never been a better time. If you've ever thought about doing this, I mean, it's just better than it ever has been ever since options were introduced. So it's really good right now. So it's one thing to create these spreads, but how do we know that our chances of winning are 85 to 90% or better? Now that's a good question. Everybody has a trading strategy, but are they going to actually tell you your probabilities of winning? And is having a super high probability of winning important if we're talking about our retirement money, or the money that we really need to be there for us? So one of the neat things about options is, we've already mentioned this, but they're based on a mathematical formula, the Black-Scholes pricing model. So whenever we sell an option, we can instantly see what the odds are that it will expire worthless. Now, if you're not down with this math, if this isn't real familiar to you, if you haven't, if none of that makes sense to you, don't worry about it. The analogy that I like to use is you don't have to know all the internal workings of the combustion engine to drive your car to the bank. You just need to know where the gas pedal is, where the brakes are, and where the steering wheel is. So here's the Thinkorswim platform. Now, they are my absolute favorite options broker for a bunch of different reasons. They get really good fills. They can usually get you in between on the bid-ask spread. If you negotiate with them a little bit, their commissions are even better than their published prices, which are pretty good. But another thing that I really like is their analytics. You can really see what's going on. So right here is a little box where it says layout. So if you open an account, or if you already have an account, this is really cool. So you go to this layout, and then you click this little corner here in the lower right, and it'll give you all these choices of what you want for the information in your columns. And so what I pick is implied volatility, probability of being out of the money, and the delta. So those are all really important to option sellers. And so let me give you an example here. Down here, so here's our position on Chipotle. This is our call spread. And so you can see that if we just go right across the columns here, we're selling the 570 and we're buying the 575. And so here's an example. So we go, probability of being out of the money is 89. What we sold has an 89.93%, or basically a 90% probability of being out of the money. In other words, a 90% probability of expiring in your favor, where you get to keep all the premium. And if you keep trading, Obviously, you're going to lose statistically on 1 out of every 10 trades, but I'm going to show you some really cool things that you can mitigate that so you don't lose so much. You'll never lose the max if you just set the orders the way I'm going to show you, but you have this probability of winning the max about 85 to 90% of the time. And as a trader, I just find that enormously exciting. So I can just tell you that I've done every options strategy under the sun. I've been trading options professionally now since the mid-90s. I trade a lot of contracts, and this is where the majority of my money is right here. And as you go along and as you get smarter as an options trader, what you're going to find is the people that stay in the game, the people that last, that really make their living trading options, they end up being primarily option sellers. And you can take a small amount of your account and use it for speculation, and that's really fun to do, but the majority of your money is going to be in this 90% probability of winning category. So these probabilities really do play out over the long run, which makes for great odds. Plus there are adjustments we can make to make our trades better when they go against us. So I know this sounds kind of crazy, but I welcome the occasional trade that needs to be adjusted because it says two things. Number one, we're selling close enough to the underlying to have to adjust once in a while. And by the way, selling close means bringing in more money. And number two, we have the means to adjust our way out of almost any situation. And that makes you feel powerful and confident in what you're doing. And that really turns out to be true. I mean, I've had some really dicey trades, some just crazy trades, and we've been able to do things, buy things back, you know, do other things, roll things out, and come out of the trade okay, where you never thought you'd be able to. In conventional options buying, if a trade goes against you, you're kind of screwed. You can stop out of it and minimize your loss, but that's about the best you can do. With this option selling, you can actually turn trades around where you take a losing trade and turn it into a winner, and we actually have a really, really good success rate in doing that. So adjusting your spreads means to close a spread that is being threatened and then open a new spread to bring in more money. And all it takes is a few mouse clicks, and it is very, very effective. So I'm going to just show you an actual example right here. So the chart on the left is when we first did the trade. So as you can see, we want to do a condor. We want to sell a spread up here. We want to sell a spread down here. We want to take in some premium. And it kind of looks like, you know, we're right in between our two wings. It looks pretty safe. So the stock is hovering around 169. So we sell this call spread, the 174, 175, and then the 163, 162 put spread, expecting them to expire worthless. Well, here's the problem: is Murphy is alive and well in the financial markets. No matter what you trade, whether you're a commodities person, a FX person, a options person, stock person, I mean, they just tend to go and do crazy things that you don't expect. So here we thought this thing was going to go sideways, and what does it do right after we buy? It just absolutely plunges. So it falls right after we sell our spread. So what do? This spread right here is now being threatened. And if this is overrun, we could potentially get a maximum loss. Well, it's obvious that the stock is falling. We don't want our spread to be overrun, so we close it. Now that costs us some money to close it, more money than we took in, and we have to make that money up somehow in order to come out profitable on this trade. So what we do is we open a new spread, new call spread right here, and a new put spread right here. So what we do is we just bracket it once again, and we take in premium on both of these, and it more than offsets the premium that it cost us to close. That's called rolling out. This is a really simple example of one of the things that we can do, but it's effective because chances are, you know, after a big move like this, you know, it starts to consolidate or move sideways or whatever, and most of the time you get a worthless expiration. So being able to adjust our positions and having the probabilities on our side is critical for the success of our plan, along with good chart reading and looking forward at the fundamentals driving the market. So for example, you wouldn't sell a spread right before earnings. What you are looking for is low volatility. So even if the stock just took off or just had an earnings announcement and it crashed, you know, by a whole bunch or whatever, if it starts to move sideways and it looks like it's just going to take a breather for the next couple of weeks, that's actually a good time to sell premium. So we want more than theory. We want a proven plan, a proven path to follow. So has anybody actually done this with good success? Well, we have since 2010. So I've been, you know, selling options for a long time, but officially put the strategy and the service and a subscription together that people can follow my trades since 2010. But has anyone else done this? We want some proof. If you're watching this presentation right now and you're going, this guy sounds like every other, guy touting this program I've ever met, where's the proof? Does this really work? Is this a strategy that can actually make me some money? Is this strategy duplicatable? Yes. So I've got a lot of subscribers I could turn you on to, but they're all my subscribers. I want you to actually go out there on the net and find somebody that is completely unrelated to me. I've never actually even met this person, but the evidence is pretty strong. So there's a woman named Karen that started trading 100,000 of her own money using this exact strategy, and she even used the Thinkorswim platform to do it. So she had saved $100,000. She was an accountant, big corporate accountant. She wanted to quit her job. She was tired of the corporate world. She had managed to save $100,000, and she was going to open a bagel shop. She thought that would be really fun, really cool. She likes bagels, and she thought it would be neat to have a bagel shop. And a girlfriend, this is back in 2000, talked her into going to an options seminar, a live options seminar. And the seminar was kind of expensive, but they split the cost, and they went, and they started trading. Well, she made a lot of mistakes in the beginning, like a lot of us do as traders, but she finally discovered these options selling strategies. And she thought, as an accountant, anybody that understands numbers, the people that are on my service, the ones that really get it are the engineers, the accountants, the mathematicians, bookkeepers. Anybody that understands numbers and probabilities loves this strategy. So she was so successful, wealthy individuals and institutions started giving her money to manage. Eventually, she was managing $95 million. And over the course of 3 years, she made $41 million using this strategy, and she's still trading today. So and this is sort of the proof that has nothing to do with me. So you can go out there on the internet, and there's a YouTube video where Karen is interviewed by Tom Sosnoff, who's one of the founders of Thinkorswim. And to find that video, just Google Karen Super Trader Tasty Trade. And the first video is 24 minutes and talks about her making $41 million. And the second video is 51 minutes long and talks about her making $105 million over a longer period of time. And they're both pretty inspirational. Now, the reason I'm pretty sure that this actually happened is Tom Sosnoff owned Thinkorswim during the time period where Karen was making these huge trades. They had to monitor her trades because they were so gigantic. Brokerage firms have a certain amount of risk. If some trader goes haywire and they're not covered, it can affect the brokerage firm. So this is where Karen came to Tom's attention, and he just thought she was so dang fascinating he had to interview her. So the first interview is in the spring of 2012. The second interview takes place in the fall of 2012, and the amount of money that Karen made is just mind-boggling. Now, she did credit spreads, exactly what I'm teaching you here, for the first several years, and then they got so much money, and they worked out some advantageous things they could do with their margins, so she just actually sells the options now. So she sells them naked. I don't really recommend that to us as just, individual traders because the risk is too great, but the strategy or the idea behind it is the same. She sells options that expire worthless, and she makes a ton of money doing it. She's a really cool woman. I think you're going to love watching these interviews. I encourage you to do it. She does a lot of work with charities over in Africa, trying to improve a lot of the folks that live over there with this money that she's making. And she's also making her investors a lot of money. So pretty inspirational. It's kind of proof to me, and I mean, I've done it myself, but I want you to have your own proof that this strategy works really, really well. So Karen talks about selling about 56 days at a time for optimal returns, but that was before they made the changes in 2012 to weekly options. So we can now sell less time and get bigger returns than Karen has been getting. So the way weekly options used to work is the option would be created on Thursday of the previous week before expiration. So you'd have a week and 1 day for that option to expire worthless, and you couldn't get into it any sooner than a week out. Well, in the spring of 2012, what they did is they actually started saying, well, you know what? Why don't we have certain things that are really heavily traded with a lot of volume? Why don't we make it so that we have an expiration Friday every Friday for the next month or so. So what's really cool about that is you can pick the time on the time decay curve that you want your option to expire. So what Karen was doing is she was doing 56 days of time. So she'd sell right about here. So what this is a time decay curve. So as you can see, 4 months out, an option decays in, not that much. It's kind of flat, the amount of time decay that goes on. 3 to 4 months out, the time decay curve starts to steepen up just a little bit. The reason she liked to sell at this 56 days of time is because this is when the time decay curve started getting a little bit steeper. Well, what I discovered that with the weekly options is the perfect time for us to sell is between a week and a half and 2.5 weeks of time. So right in here is the absolute sweet spot. And if you think about it, what you're really trying to do here is you're trying to sell something for a decent amount of money that very quickly expires worthless, so that you're out of the trade, you have no more risk in the trade, and all that premium that you sold has taken up permanent residence in your brokerage account, which I think is a great place for it. And so what we want to do is we want to get to the finish line fairly quickly. We want the time value that we sell to decay fairly rapidly. And this is just the perfect spot. And this has only become possible by weekly options, so we can kind of pick our Friday. Instead of, having to sell out to the third Friday of every month, which is, used to be the only time that options would expire, now with certain indices, the SPX, the SPY, the IWM, the RUT, certain things, we can pick our expiration. And this has just changed everything. This has made it so good. So think about it. Karen used to have to get paid in 56 days. We can now get paid in about 10 days. So we can cycle our money that much faster. Think about what that does to your rate of return. You're making money on your money. So you're compounding your rate of return so much faster than what traditional options traders have been able to do. So we're taking what Karen has done as the inspiration for a new program designed to get anyone who follows it retired within 5 years. So these trades will be more conservative than our usual spread trades because we are willing to accept lower returns for a higher probability of winning. And when I say lower returns, I'm still talking about getting 15 to 20% every couple of weeks. So our typical spreads yield anywhere from 15% to 30% per month. But what if we just went for much more safety and targeted just 10 to 20% per month? And I rarely get 10. It's usually closer to 20. Over the past 3 months, we've actually been averaging closer to 20% on our retirement trades, but we have to factor in occasional losses, commissions, and the fact that we set aside money for buybacks and rollouts. But we're also averaging 2 weeks per trade instead of a month, so we're compounding a lot faster. So what can we expect? So this is a good question. If we're typically getting 20 to 25% per trade. So I'll tell you how my service works is I come out with 2 trades every week. And I come out with them on Tuesday evening, and then you can place those trades Wednesday morning. I've got an aggressive trade, typically shoots for about 25% return, and then I've got this retirement trade, this more conservative trade, which is typically around 15 to 20%. So that's what we're getting. We win on about 90% of our trades, but once again, you always have cash set aside for rollouts and buybacks. That's just a safe thing to do as a spread trader. So we're not using our whole account. So what can we expect to make every 2 weeks? 20%? Probably too high. We're going to have some losing trades. We're going to have to set aside some money for buybacks. 15%? Does that sound reasonable? Yeah, probably close to 15, probably over the long run if you factor in a few losses or, just crazy things that happen. Maybe 10% every 2 weeks. Once again, if you want to get really inspired, get out your calculator and figure out, making 10% on your money every 2 weeks, what that turns into. It gets pretty inspiring. But let's just cut our expectations way back. So let's talk about getting 5%, and instead of every 2 weeks, let's talk about getting 5% per month. And, I think that's less than we've actually done for a long, long time. I mean, we make more money than that. But let's get conservative. Say you're a little bit skeptical, and we just want to tone things down and expectations down a little bit here. So let's talk about getting 5% per month you know, that's still a very impressive return, especially when that money is compounded. So if we're really going to build up that account, we want to have as much of our money working for us as possible. In other words, we want to compound our returns in a tax-free environment to get all of our money working for us all of the time. Plus, wouldn't it be nice to be able to take all that money out tax-free when it's time to live off of it in retirement? Well, of course it would. We're going to put our money in a special account that can build to infinity without having to pay any tax on the profits ever. I really like that idea. Now, you know what? If you don't know what the big deal about taxes is, all I can say is you haven't made very much money in your life. If you've made a lot of money, with our progressive tax system, all of a sudden you become public enemy number one. And boy, they really hammer you. And they start taking all kinds of deductions away from you. Do you know that if you make a certain amount of money, you can't even deduct the mortgage interest on your home? And you start paying just ridiculous percentages of your income in taxes. So if I seem a little pent up about taxes or a little bit, you know, have a little bit of angst around taxes, the reason is because I paid a lot of taxes in my lifetime. And, you know, it's great to make a contribution and all of that, but wouldn't it be kind of neat if you could keep a little bit more of what you made, or in this case, all of what you make? So that special account is called a Roth IRA. And this was created in the Tax Relief Act of 1997, and it's about the coolest thing that Congress ever provided for us. So the characteristics of a Roth IRA is contributions, well, they're not tax deductible like a regular IRA, but that's okay because all the buildup you get to keep. So you can contribute up to $55 per year if you're under the age of 50 and $6,500 per year over the age of 50. Direct contributions to a Roth IRA may be withdrawn tax-free at any time. Remember that. There's no penalty and there's no tax. If whatever you contributed you want to take back, you want to do something with it, you can do it. Earnings may be withdrawn tax-free and penalty-free after the age of 59 and a half. So 59 and a half, I'm beginning to realize, is not that old. And you can take out your profits, your earnings, some of the buildup. You can start taking those, and you can take as much as you want after the age of 59 and a half with no penalties and no taxes. Distributions from a Roth IRA do not increase your adjusted gross income, so these earnings do not increase your tax bracket on your other income. That's really cool. So it's like you never even made it as far as taxes are concerned. The Roth IRA does not require distributions based on age, so all other tax-deferred retirement plans require withdrawals by 70 and a half. You don't have to do that. Unlike distributions from a regular IRA, qualified Roth distributions do not affect the calculation of the taxable Social Security benefits. So you can be taking $1 million out of your Roth every year, and it doesn't affect your ability to collect Social Security. So assets in a Roth IRA can be passed on to heirs. So this is so unbelievably cool. The one thing about a Roth is the contributions you make have to be out of earned income, so it has to be out of your payroll or paycheck. And if you make a certain amount of money or above a certain amount of money, you don't qualify for a Roth. So single filers, it's up to $110,000 to qualify for a full contribution, and joint filers up to $173,000. Now, if you're making a lot more money than that, well, that's great because you probably have more money to set aside. But if you're under those brackets, I mean, just a Roth is like the coolest thing they ever invented, especially if you're planning on making a lot of money in your brokerage account. You know, just fantasize about that for a minute. Can you imagine, making compounding, this 5% every month or every couple of weeks, and doing that for 5, 6, 7, 8, 9, 10 years and not having to pay any taxes on the buildup? I mean, this is like amazing. So the amazing thing about a Roth is that you can build up any amount of wealth in the account you want, and as long as the distributions are taken after the age of 59 and a half, the money you take out is completely tax-free. So if we're averaging just a 5%, not every 2 weeks, we're getting our expectations nice and down here, nice and low. Let's make this, as believable for you as we possibly can. And I just want to tell you we're doing better than that. And I've got the publicly shown track record to prove that. You can go to thewinningsecret.com and see that for yourself. But if we're averaging just a 5% monthly return and we are only using the money we can put in a Roth, what kind of account can we build up in 5 years? It's a really good question to be asking yourself right now. So let's take a look at that. The maximum we can put into a Roth is $6,500 per year. So if we put that amount into the account every year for 5 years and got just a 5% per month return trading this strategy, how much would we end up with? So this is it. So at the end of your first year, you've got your $6,500 has grown to $11,673, and you're getting $584 per month. Maybe not that inspiring to you. Maybe it is inspiring. $584 per month can probably pay some of those utility bills. But by the end of year 2, keep in mind this is compounding. It builds quickly. Now it's up to $32,636, and you're getting $1,600 per month. Do you realize people are out there living on $1,600 per month, especially some seniors? You know, this is substantial, and this is after year 2. Year 3, you've got $70,000 in your account. You're getting over $3,500 a month. This is where things start getting interesting. At year 4, look at this graph, everyone. This is what compounding looks like, is your graph starts going exponential, your line of increase. At the end of year 4, you've got almost $138,000 in your account, and you're getting just about $6,900 per month. Things are starting to get pretty comfortable for you, and this is starting to get pretty exciting. At the end of year 5, you've got $259,000 in your account, and you're getting just a hair under $13,000 per month. And that's how the math works out at 5% per month. Now, I'll tell you something. I've advertised 5% per month to folks before, and that's typically what you'll see on the website because I believe in under-promising and over-delivering. But I've had veteran credit spread traders emailing me, go, why are you advertising such a low return? That's just stupid. I get 10 to 15% a month all the time. I'm going, okay, that's great. So do we. We do really well too. But I want to just advertise something really, really conservative here to make this more doable and more realistic for you. So that's a pretty impressive. But since you never have to take the money out, it's possible to just keep on building it. So if you're a little curious about what the rest of this graph looks like, what do years 5 through 10 look like? Let me show you what compounding can do. Now, at the end of 10 years, what are you going to be bringing in, $458,000 a month? Probably not. There's a lot of crazy things that can happen between here and getting, $500,000 a month. There can be blow-ups in the stock market. You can, it's just like the board games. You can go back, take a bunch of steps backwards. I don't think that this is what's going to happen. But I'll tell you what, Karen is doing it on an even larger scale. The build-up here can be pretty darn impressive. And I've got some guys out there on my service that are subscribing, and they just like what we do, so they subscribe. But I'll tell you what, they're a lot smarter than I am. They're these older guys that are really good with numbers, and they tell me what they're making, and it blows my mind. There are some people out there with some super comfortable retirements that never got a pension plan. They never had that in their work. But boy, they created their own, and they're awfully darn comfortable doing this exact strategy. So for now, let's just go back to our original 5-year plan. The very next month after your 5 years is up, you have $272,000, and at just 5%, that amount brings in $13,614 per month, tax-free. This is very doable. I opened up a Roth myself, and this is what I'm doing, and I'm seeing that build up, and it's inspiring. You're not going to have to worry about your retirement. Now, I realize we don't live in the calculator world. We live in the real world. In the real world, we won't get exactly 5% every month. Sometimes there'll be setbacks, and sometimes we'll do better, and most of the time we do better. But the point is, the plan looks like it will work, and it is working, and it's working right now. I opened a Roth IRA at Thinkorswim, and if you let them know that you have options experience, they will let you sell credit spreads in the account. If you decide to come along and do this with me, I'll even set you up with an account representative at Thinkorswim with the inside track to discounted commissions, and that gives you a huge advantage. We have a contact there. He says, you know what, you guys doing credit spreads are doing a lot more contracts than our average trader. I would be happy to give you some discounted commissions for your business. So if you're going to subscribe with us, go ahead and get a hold of our office, and we'll get you in touch with our contact at TD Ameritrade, which is the parent company of Thinkorswim. So we're doing 2 trades per week. The first is our usual, more aggressive, higher return credit spread. But our second trade is a Roth retirement trade, and it will be a little lower return but safer. We'll be shooting for a 15 to 20% or better return with a 90% plus probability of winning. The two trades can be traded in two separate accounts, and as you've seen, the build-up over time can be amazing. This is a train you don't want to miss. I don't know what else you're doing in your trading. I don't know if you're happy with it or you're a little dissatisfied, but you're going to really like the idea and really get used to quickly. You're going to get used to the idea of winning on most of your trades, and just mathematically and probability-wise, that's exactly what happens with these. And I've been trading these a lot over a long period of time, and I've gotten very good at picking the spreads that give us the greatest return with the highest probability of not being overrun. So it's super important to me that you're successful with this strategy. So I want to make sure you've got everything you need. If you're going to come on board, I want you to be prepared. I want you to understand what we're doing, and I want you to have fun with this. I want you to make money. So to make sure you have a really good understanding of how this strategy works, you'll get a complete video presentation called How to Trade Credit Spreads for Fun and Profit. It shows you step-by-step how credit spreads work and why they work so well and how they can work for you.